James, welcome back. Good to see you again.
See you, Bergs.
We,
You're looking good.
I'm not sure about that, but I'm here. um, we've had a couple of good chats over the last couple of weeks, and one of the conversations which I was picking your brain on was on profitability within an MSP, and what counts as an operating expense, what counts as a cost of goods sold, etc. Particularly when it comes to managed services. And that's what I started off picking your brain on. I said, let's have a chat about it, because you've again got a wealth of knowledge, and would love to just elaborate and from there is understand what a good MSP is doing from a profitability perspective. But open us up, James. Tell us a little bit about what what is profit, and how do you determine profit within a business, and what's EBITDA and what's net income, etc.
I love this conversation. It's like one of the least spoken about things in terms of MSPs. We're usually talking about tickets and sales and all this other operational stuff, but very, very often we ignore the financial aspects of running our business. And at the end of the day, we're running a business to make money. Like if you're not, you're charity, and it's a very different form. And seeing how many MSP owners there are that are in their late 40s, 50s, 60s now, they're starting to look at exiting. Been doing this work for a long time, 10, 20 years, and most of us aren't paying ourselves that great, and we still got mortgages, and there's a lot of opportunity in our space that we just focus up and focus on the numbers. It's life changing. I've worked with clients that are doing the average profitability, and by reframing up the thoughts, you can run very good businesses that look after the clients and still make a lot of money for yourself and the team, and you often end up with much better results. So very excited to talk about this.
Awesome.
Like you said, there's a lot of financial terms to know.
Yeah.
There's sometimes you'll need an accounting degree to go through this type of stuff, but let's keep it simple. Let's just keep the language you'll hear me talk about a lot is revenue. It's the people call it turnover, income, lots of different terms, but you'll hear me say revenue all the time. It's what we bill our clients. It's the dollars that we're collecting. You'll hear the cost of good or cost of sales sold. Or you'll hear it shortened to COGS.
Yeah.
And all that means is the tools, the product costs, your technical labor to deliver your services.
And that's a good question. I want to drill on that because this is what confuses me. So the technical cost of delivering your service. If we look at a managed services contract, or we're delivering a managed backup solution, or we're delivering a managed service of some sort, let's just say that you've got costs which weren't anticipated. So let's say that you budgeted 1 hour of time of your technician's time per person within a business, but then a backup blows out. They've got crypto. You end up on the phone to support for hours trying to resolve something. Is that a cost of goods sold, or is that an operating expense of the cost of doing business?
It's definitely the cost of goods sold.
Okay.
And this is where we get confused, and this is where I'll take a jab at accountants, but also to defend them at the same time. A lot of us, from growing our businesses organically, we end up taking the accountant's advice, and they can only provide us generic advice in terms of business, and they're very focused on being tax agents. Yeah. They're providing us tax advice. There's very few business accountants that can help you with your business performance. So this point around the technical labor, by default, most accounting packages, most accountants will all tell you to have one line of wage costs, and that will be in an operating expense. But for us to see our profitability of what we do, we're a service-based business. So our services are our products. And those services, we don't deliver them without interacting with our people. They won't exist. If we could sell just products, we'd be a product-based business, and we wouldn't be so heavily led by all our service people. So moving those wages from that operating expense up into the cost of goods sold can then start allowing you to see how profitable you're actually running and delivering those services a lot clearer. And just for fun, what you should be doing is generating 50% gross profit, sort of the best practice. So if you're generating $1 million revenue, you should be spending about 500K in cost of goods, whatever that's built off, and then that's generating you 500,000 in gross profit. And that's when under that you'll have the operating expenses. So if you've ever heard the term above and below the line, that gross profit is above the line. That's all the activities we're doing above.
So where does an internal bookkeeper fit? Is that an above the line or below the line cost? So if you've got a generalist that's doing a bit of column A, a bit of column B.
So the bookkeeper, the generalist type people, they're often going to fall into that below the line and they're an operating expense. So operating expenses, the best way to look at that is think about, if I was running any other type of business, these are the things that I need to have in place that are general business expenses that I'd have to do. If it's specific to delivering the specific MSP type services, it's all going to be in the above the line in the cost of goods sold. And that's a really simple way of breaking it down. The other term you'll often hear for operating expenses is sales, general, and administrative costs. And that also helps frame it up. If they're not sales, general, or administrative, they're going to be above the line in that cost of goods.
So the SGA is below the line, and anything else is typically above the line. Okay, that's a good way to look at it. So you said that 50% is typical for what you see. Is that typical or is that best practice? Because I have heard some partners are 60, 65% GP.
So 50% is sort of baseline best practice. If you're doing below that, generally you're not operating as efficiently as you can. And there's a lot of opportunity to improve that. And there's a few levers to deal with that. If you're above 50, fantastic. Like you want to be higher than that. If you start getting above that sort of 60, 65%, it's probably because you don't have the COGS. You don't have the technical costs in your COGS, and you don't have the right. So most best run MSPs are going to float between that 50 and 60% gross profit, and it can be affected a lot by your split between product and service revenue as well. So I'm very much talking about a service, a more service focused technology business than that's the more traditional box dropper VAR product reseller.
Gotcha. So it could be you start off, you've got a few staff, and then you've got that decent margin of 60+%, and then as you scale, you need to hire someone else, or as you grow, you hire someone else, and that actually drops your profitability down, but allows you to drive a bigger revenue number at a smaller margin.
And a lot of what will drive it down is having those sort of non-billable service related staff like dispatchers and things. So they're not administrative. They're actually they're only there to deliver the service, and that's where people get confused.
Gotcha.
And it is confusing, and there's a lot of detail. But if you stick to some of the basics to start with, then you have a clearer picture, and you can get more and more granular as you're learning more and as you grow and as you need more detail.
I really like that above the line and below the line in terms of COGS and OpEx, in terms of how to think about it. So we talk 50% your baseline for best practice on your GP line. What about your EBITDA or your net income?
Yeah, so EBITDA, it's worth sort of talking about the different type of profit. So I already mentioned gross profit, and that's that sort of above the line profit. What you'll often hear down in this part of the world is net profit or operating income, and then you'll hear from more accountants and stuff around EBITDA. And basically what EBITDA is for the general technology business is your expenses before all the complex accounting work. So EBITDA stands for expenses before interest, depreciation, tax, and amortization. So for the average MSP, it's all the typical business performance until your accountant gets to it at the end of the year. And then that's your tax net profit. So the EBITDA can get confused a bit with the net profit, but often when we're talking about the average MSP, it's really going to be like your net profit on the on your zero P&L is going to line up to EBITDA most of the time. So best practice that we're aiming for at minimum's 18%. So if you're $1 million company, you should be generating 180K in net profit.
After you paid yourself, your staff, that's your profit that you put in your back pocket or your bank account to reinvest, etc. in the future. And what are you seeing as the average in Australia? 6 to 7. Interesting. So a bit of a gap there in terms of best practice and common average business. What are the commonalities between what you see in a 6% EBITDA business and an 18% EBITDA business?
Well, let's start with what good looks like, and it'll become apparent for people that aren't managing to what good looks like yet. So we already spoke about that 50% gross profit. What I'm seeing is if you're not running at 50 to 60% gross profit, you're very much not going to achieve the 18% EBITDA straight out of the gate. And this is why it's important to have the wages in the right area, because this is what lets you hone down into what particular things aren't performing well. So even at this high level, if you're not 50% or above on gross profit with that simplified P&L, well, is it your wage costs that are the most difficult issues? Is it we're not charging enough? Do we have too many tools to deliver the services, etc., etc., etc.? We can focus on that. What they're also doing to get that 18% profit is the operating expenses that we were talking about, the SG&A, is the businesses are managing that component to 30% of total revenue or less. So what that basically means, if we're doing $1 million business, that we're only spending $320,000 on our operating expenses or less for that period. So if you're above that, then again, you've got these two big components to look at. If you're running at 50%, but you're spending 50% on operating expenses, this is how high level it breaks down.
And if you've got a sales rep that's on a 50-50 split of base and commission, where do you see them fitting? Is that all above the line?
That's all below the line in the operating.
The sales rep is
sales rep is in the S part of the SG&A.
I should have known that.
Sales component.
I should have known that. Simple sales guy.
This is why you're a salesperson.
I don't even know all of this. This is why it confuses me. So the sales is below the cost. What about commission? Is that a cog? That's still
below that's below the line typically. It depends on the structure, and this can get super complex super quickly, but typically all your labor, the labor component of generating the sales would end up in that sales component. Because when we segment it like that, we're able to manage by other percentages as well. We can get super detailed of like, typically if you're not spending 5 to 6% on sales as a total of your revenue, you're not spending enough. So there's a lot of MSPs that are only spending like 1 to 2%. So we're not generating the sales. Or if you're spending like 10, 15%, which a lot of MSPs do as well, we're overspending and we're not getting the results. So this sort of structure is the sort of foundational basis to get more and more into that.
So to drive EBITDA, you either sell more with your existing cost structure or sell the same and just reduce your operating expenses and your SG&A costs. So we talked on the OpEx as sales being one of those costs. What are some of the other inefficiencies that you're seeing within a typical MSP below the line costs?
Marketing. A lot of people are overspending on marketing and not getting the results. And a lot of the time I'll stick up for some marketing companies. It's because MSPs don't have a strategy around it, and they're just falling into, we need to spend on SEO and AdWords and things. The other thing is having too many admin staff. It's a very common problem. Like I can see a 20-person MSP where they'll have 3 or 4 admin non-billable staff. There's just it's not necessary in this day and age. There's a lot better ways that we can run that, and especially as we're starting to get into these decent sizes. A lot of the PSAs,
a procurement officer, that's a below the line cost.
A lot of this work fairly easily.
So anyone that is spending time ordering licenses, ordering products, dealing with vendors, negotiating costs, what's in stock, what's out of stock, doing invoicing each month from lots of different vendors.
I've seen some crazy amount of non-billable staff, and just taking the time to understand best practice setups and the system, getting the systems to run. There's so many good systems and processes these days compared to when I started in the industry. Like, there's no excuse anymore. Like, you shouldn't have to throw labor at that. That's a huge component, time and time again. A lot of the smaller guys, just to throw it out there, they'll be sitting there going, "Oh, actually, my wife does that," and a lot of the time, you can probably make them redundant out of the business, and a lot of people feel bad about that, but actually, most of the time, that's a good thing. I can say it because I haven't done it, but most of my experience of the wife ends up doing a lot of this behind-the-scenes work because no one else will, and they're the ones that made sure that there's food on the table because the owner's not been good at invoicing and things like that, so they've stepped in and done it. But a lot of the time, the wife doesn't want to be there, so there's often cheaper alternatives in terms of outsourcing that component that can be repeatedly done. Decreases profitability. You're still going to take, as a small business, you're still going to be able to take that money as dividends and stuff. Like, it doesn't mean that your wife stops working and you don't get to take that money.
It's about simplifying that,
but actually that
process of buy, selling, manage, invoicing SaaS applications. This is what I've cottoned onto recently, having joined the business a few months ago, is that the amount of headaches associated with procurement, with invoicing, with vendor management, there's this thing called vendor fatigue, where that administrator is on the phone or in systems going back and forth. And if you think about the future of the industry, I heard a statistic the other day. I think the average MSP's got 18 different vendors that they work with, and that's only going to continue to grow 24 by 2024. So I think if we're not careful, if we're not thinking about our bottom line profitability, we're going to see OpEx creep, where there's a creep in our expense or cost of managing all of these things that we're not even thinking about today. So what can we put in place that allows us to put a lid or a cap on some of those kind of exponential costs?
And I'd add to that too, because it is a very important point. Like, we've got to create scalable businesses. That if you're going to manage, the OpEx is often the easiest thing to manage inside our businesses. And honestly, when I get into an average MSP that's $1 million to $3 million,
and it's easy to do in a growing and a fast growth business when you've got multiple stakeholders and decision makers, and if there's a bit of money injected. My former company that I worked with, they went through a rationalization process. The first bout of COVID, going, hang on, let's prepare for the worst. And they saved themselves $10 million in software fees just by paid for not being used. So I think that it's a good idea for us to all do that. Is just reflect on what is truly required,
and don't actually end up using it and deploying it. Like, it's crazy.
It used to be a nice to have, but we're still paying
for stuff and not managing those costs. and you've got to, and you've got to be a bit brutal about this. I find often, I've done it myself too, is you end up running the business like it's monopoly money instead of actually it's your own money as a small business
Revenue
owner.
per,
It's like
per
as soon as you
non-billable
change that
resource, anything
mindset
like
to
that that
go,
are useful?
is that $1,000 we're spending on that tool making a difference to our business, or could that $1,000 be paying my mortgage off? Which one would you personally choose? When you start getting down to that sort of black and whiteness, you'll find a big shift in that mindset. And I think it's worth mentioning as well with talking about cutting operational expenses, and we're managing like procurement people and non-billable resources to do the reconciliations.
Additional
Because
revenue
we're
on the
very
top
inefficient
line,
in general, and there's better ways
being
to do
efficient
it.
with what.
But often what happens in that
I have a good friend that was trained to do an Ironman.
is we get so it gets so hard that we give up on it, and then we start missing out on not just paying the extra cost of having the admin burden. We miss out most often on the additional revenue that we should be generating. And a lot of us, it's a bit weird. A lot of us in the MSPs are focused on revenue growth, but we're focusing on new business instead of managing our existing business and revenue growth inside that. And if we're lining up, making sure that we've got the right amount of headcount for our service delivery and we've got the right back end, we can add quite a significant amount of revenue to the business without having to add more heads. I've coached clients through it where they've been around like the sort of 1 to 2 million mark, and they have maybe 10 to 20 people in their business and they're not profitable. Where once they start pricing their managed services up correctly, adding more white space to sell to inside their clients, they find they don't have to add any more people on, and they can double their business, and their profits go up and up and up really quickly, just from managing that revenue without having to go chase down new leads and new business. I'll typically look at endpoints per tech is a good one, because I'll say this with a bit of caution. It's a bit more deeper. It's really a health indicator to start the conversation. Don't go if you're not meeting the indicator. Don't just go chop heads, because there's a complexity to this as well. But your typical average MSP should be able to be managing 300 endpoints or more per tech. If you're not doing that, the only legitimate reason for that should be you're working with highly complex environments and they're paying you a premium to do it. If you're a normal MSP, if you're not 300 and above, you've got an imbalance there. And typically it will be you're not pricing it correctly. I'll just cut to the chase for everyone. You're inefficient. You're probably super busy. You will get efficiencies through better processes and things like that, but time and time again, it's actually legitimately busy in the service department because you've got such a large environment. It's not standardized, and they're not paying you enough to manage their environment. No, and that's why a lot of us are stuck where we're stuck at the moment, because we're super busy and we don't have the money to invest to improve it either, which is really challenging when the margins are getting squeezed with our salary costs skyrocketing as well on top of this. I think what's super important with this for most MSP owners, and we've touched on it earlier, but I think it's well worth reiterating. So you actually need a purpose to this. We need to take away the fact that the business is monopoly money and give some tangible outcomes, whether that's you're running a deliberate lifestyle business that you're running a good sustainable business that's generating high profitability and you're just ripping all the cash out and investing outside. Great strategy. I know quite a few business owners that are doing very well from that. Or we're actually reinvesting for growth. And when I say that, we all think we are, but we need to actually make decisions based on what kind of ROI we're going to get, not the emotional side. And this is where a lot of people go wrong, and they sit in the middle between an actual growing company and a deliberate lifestyle business, and they keep swaying between, and they achieve neither of those solutions. So when we talk about like 6%, 7% profit as the industry average, it can be okay for you to run at that sort of 7% mark if you know the business is reinvesting in growth, and then if you stop the actual reinvestment, it would run at the best in class profitability. And you have to test that sometimes. So some of the really fast growing businesses that I know and I've worked with, they're not running at the 18, 20%. They're running lower because they're investing in having more staff. They're doing that. But they're very deliberate in that spending of money, where most of us think we're investing in growth, but we don't actually know the ROIs that we should be getting or measuring it. And if you should be able to stop spending and it go up and see the model work if you're working it well. And I know very much so the majority of MSPs that are running at that 6 to 7%. And I just want to highlight for brevity, that's the average. So that means there's a lot of people that are generating less than that and are losing money. So there's a lot more that aren't doing well than are. They're not spending and getting any ROI. So slowing down, don't go and gut and burn the whole company from this conversation. Take some of these tips that we've told you in those high level numbers of, let's get the techs above the line. Let's see where we're running compared to 50% gross profit. What's our SG&A, our operating expenses? Is it above 32% or is it lower? What is our profitability? And slow down and find our low-hanging fruit that we can cut back on or we can increase. And then use this as a time to go create a business plan to go, what am I aiming for? Set yourself a target, maybe 18%. If I'm running at 6%, do not set a target for 18% because it's going to be soul crushing and it will take a couple of years to turn it around. But you might want to go from 6% to consistently running at 10% per month. And then once you're there running consistently, then I might push for 14 to 15 and like slowly incrementally move the needle up. And base your activities and your focuses in your business plan and the company on what are we going to do to make 10% profitability decisions? What am I going to do that can move the needle that 4 to 5% in profitability and get it consistent? And then do the next one, then do the next one. I think we could go on and on and on, and there's so many levers to pull, but that's a good place to start. We can dive into food. Yeah, great. Thank you. I look forward to catching up next time.